Right now, while you're watching this, someone is buying the asset you keep telling yourself you'll buy when the time is right. They're not smarter than you. They're not richer than you, yet. They just stopped waiting. The window is closing. And here's what nobody will say out loud. For most Americans, it may already be too late. In 2020, the American economy split in two. Not slowly, not subtly, violently. Economists called it the K-shaped recovery. Picture the letter K, two arms, one hinge point. The upper arm climbs, the lower arm falls. And every single day that passes, those two arms move further apart. Now here's what the financial press will tell you. They'll say it was the pandemic, supply chains, a once-in-a-generation disruption that nobody could have predicted. That's the version they want you to believe. Here's what those on the upper arm don't want you to know. The divergence wasn't an accident. It was a predictable outcome of policy decisions made by people who already owned assets, made by the very people who would benefit most. When the Fed flooded the system with trillions in liquidity, they knew exactly what that money would do. It would flow uphill. It always flows uphill. The working class got stimulus checks. The ownership class got a decade of wealth creation compressed into 18 months. And not one major financial network led with that headline. Ask yourself why. Let's talk about what they taught you to do with money. Work hard, spend less than you earn, save the rest. It sounds responsible. It is financial surrender dressed up as virtue. A high-yield savings account today pays around 4 to 5% annually. Now run it against inflation. The Fed targets 2%. We've been running hotter. Core inflation has been persistently elevated for 3 straight years. So, you earn 4%. Inflation takes 3.5% to 4%. Your real return, before taxes, is nearly zero. And that's before taxes. After federal income tax on that interest income, depending on your bracket, you are earning a negative real return. You worked for that money. You sacrificed for it. You delayed gratification for it. And inflation? Silent, invisible, relentless, pickpocketed you in broad daylight. Every single year. Now, here's the layer underneath that most people never reach. Who benefits when inflation erodes your cash savings? The borrowers do. The leveraged do. The asset holders do. When the dollar loses purchasing power, real assets priced in dollars go up in nominal value. Your savings bought less. Their portfolio statements showed bigger numbers. Same inflation event, opposite outcomes. This is not coincidence. This is the architecture of the system. And the people who designed that architecture are not in the lower arm of the K. I want you to think about the last time you said, "I'll start investing when things settle down." How many times have you said some version of that? And while you were waiting for clarity, the upper arm climbed another notch. The canyon got wider. Because the psychological trap of waiting for certainty is the single most effective wealth destruction mechanism ever devised. And here's the darkest part. It wasn't installed in your head by accident. A workforce that believes wealth is out of reach stops trying to play. And a workforce that stops trying to play keeps showing up at someone else's business, at someone else's hours, for someone else's benefit. The system doesn't need you to be oppressed. It just needs you to be distracted long enough to miss the window. I want you to imagine something. You wake up tomorrow,
and there's a line item on your bank statement. It says, annual savings penalty, $3,200. You'd be furious. You'd call the bank. You'd demand answers. But inflation does exactly that, silently, every year. And most people never notice. Because there's no line item, there's no bill. There's no press conference where someone stands up and says, we are going to make your savings worth less so that asset owners can get wealthier. They don't say it, but the math says it for them. Your money is shrinking. Their money is multiplying. That gap does not close by itself. It closes only if you change what you're doing, and the window to change it is not unlimited.
Here is what the data is starting to show, and what very few people want to say publicly. Wealth mobility in America is declining. A 35-year-old who has $200,000 in productive assets growing at 12% annually will have approximately $2.1 million by age 60. A 35-year-old with zero productive assets, saving $1,000 a month in cash, will have approximately $350,000 by age 60. Same discipline, same time frame, same country. A $1.75 million gap, created entirely by decisions made before age 35. Now here's what makes this conspiratorial in the truest sense of that word. The financial education system in this country, taught in schools, reinforced by mainstream media, endorsed by institutions that profit from your deposits, teaches you the $350,000 path. The $2.1 million path is not a secret. The math is public. The logic is accessible. But it is never, never the centerpiece of what gets taught to working-class Americans. Informed, asset-owning citizens are harder to employ cheaply. Uninformed cash savers are not. The wealth gap you see today is not a snapshot. It is a trajectory. And trajectories, left unchanged, become destiny. Let me tell you something about windows. They don't announce themselves when they open, and they don't ask permission when they close. The railroad window opened in the 1860s, closed by the 1890s. The oil boom window opened in the early 1900s, closed by mid-century. The internet window opened in the mid-1990s. By 2001, closed. Each window, open. Each window, closed. The people inside those windows when they were open became the wealthiest families in American history. The people who watched from the outside, or who almost got in, or who were going to get in next month, are not in the history books. And here's the part nobody talks about. The people already on the upper arm weren't reading about those windows in the newspaper. They were getting the intelligence before it hit the newspaper. By the time the opportunity is headline news, the positioning is already done. The early movers have their cost basis. The late movers are buying their exit. We are inside a window right now. This window is open. It will not stay open. The window is closing. Here's the most uncomfortable truth in this entire video. You probably already knew most of what I've told you. You've seen the compounding charts. You've nodded along to content exactly like this before. And you changed nothing. That is not an accusation, that is a pattern. And patterns, in markets and in human behavior, predict outcomes. The information gap between wealthy investors and everyone else is essentially zero in 2026. But the behavior gap is wider than it has ever been. Most people consume financial intelligence as entertainment. They feel temporarily activated. They make a mental note. They return to whatever they were doing before. A small group consumes it as operational intelligence. They build frameworks. They take positions. They stay in. That second group is pulling away from the first at an accelerating rate. And here is what makes this permanent. Compounding doesn't forgive delays. A year lost at 35, in a high-conviction position growing at 15%, costs you multiple years of equivalent savings at the back end. You cannot work your way out of that math. You cannot hustle your way out of that math. Every week you wait makes the math harder. Every month you wait makes it significantly harder. Every year you wait. You are not standing still. You are falling behind at a compounding rate. And the people ahead of you are not slowing down to let you catch up. They are compounding away from you, in real time, right now. I want to name the thing that is actually stopping you. It's not lack of information. It's not lack of access. It's a feeling. The feeling that says, not yet. Wait for more clarity. This isn't quite the right moment. That feeling has a name in behavioral economics. Loss aversion. Your brain registers the pain of a potential loss at roughly twice the intensity of an equivalent gain. So, you wait, because waiting feels safer than moving. But I want you to understand something about that feeling, and I want you to understand it in your bones. That feeling is the mechanism. It is the single most powerful force keeping the lower arm exactly where it is. More effective than any law, more efficient than any barrier, because it doesn't need enforcers. You enforce it on yourself. Every time you almost moved and didn't, every time the research was done and the decision wasn't made, every time the window was visible and you chose the familiar comfort of waiting. The certainty you're waiting for does not exist. It has never existed. The risk of inaction is greater than the risk of action. The downside of doing nothing, of letting inflation run, of missing the compounding years, of watching the window close from the outside, is permanent. The upper arm uses 3 levers. The lower arm was never taught to use. Lever 1. Compounding time, not market timing. Time in the market. A $50,000 position growing at 12% for 25 years becomes $850,000. The same $50,000 sitting in cash for 25 years, after inflation, is worth less in real terms than the day you saved it. Same $50,000, 2 completely different futures. The only variable is what you did with it. Every year you delay starting that clock, you are not saving that year. You are spending it, and it does not come back. Lever 2. High conviction thematic concentration. Broad diversification is the correct strategy for preserving wealth. It is a mediocre, sometimes catastrophic strategy for building it. The families that built lasting wealth found a structural transformation and concentrated into it with discipline and conviction. Then they stayed. Then they diversified after they'd won. The sequence matters. Almost nobody teaches the sequence. Lever 3. Asymmetric positioning. Find situations where the structural tailwind is powerful and the potential upside substantially outweighs the defined, limited downside. This is not gambling. Gambling has random odds. Asymmetric positioning has research, structural logic, and timing behind it. You know your maximum loss before you enter. You define it. You accept it. Then you let the upside run. These 3 levers require no special access, no insider information, just clarity, discipline, and the decision, finally, to act. I'm going to leave you with the thing I most want you to carry out of this video. The K-shaped economy is not temporary. It is not a political problem that will be voted away. It is not a market anomaly that will self-correct. It is the operating architecture of American capitalism in 2026, built to persist, maintained by people with every incentive to maintain it, and defended by a financial media ecosystem that profits from your confusion and your complacency. The upper arm will keep climbing. Monetary policy, tax structure, and the mathematics of compounding will guarantee it. The lower arm will keep declining. Inflation, stagnant real wages, and the crushing absence of productive assets will guarantee that too. And the hinge point, the moment where those two arms split, is receding further into the past every single day, which means crossing from the lower arm to the upper arm gets harder, not slightly harder, exponentially harder. Because the upper arm is compounding, and compounding does not wait. It doesn't pause while you build your confidence. It doesn't freeze while you finish your research. It doesn't hold the door open while you decide if you're ready. It runs. Without you, if necessary. The window is closing. Your move. I don't want your like. Likes are for people who found this entertaining. Subscribing is for those who intend to stay on the upper arm of the K. If that's you, you already know what to do. If it's not, I hope you remember this video the next time you tell yourself you'll start when the time is right.